In this episode of the MSA Rental Market Update, we are looking at Greenville, South Carolina's rental market for multifamily properties. You can see where the Greenville metro statistical area is drawn out by CoStar. We are in South Carolina, not North Carolina. You can see that it is right along the state line of North Carolina. Here is Charlotte. We've got Knoxville, Tennessee up here, Chattanooga, Tennessee. Here is Atlanta, Georgia, Columbia, South Carolina, and Augusta, Georgia, which is the South Carolina state line right there. All right, so this gives you an idea of where it's located. Let's go take a look at our filters and, as usual, see what we are excluding and including. So we are excluding all corporate, military, senior, and vacation, and we are including only market and market affordable so that we are only looking at conventional apartments. We then go to location. We are in market, metro statistical area, Greenville, South Carolina. So we are first going to start out by taking a look at the analytics for all three asset classes combined, and then we will break out into the individual asset classes to see if one is performing better or worse than the others. But first, let's go take a look at the analytics for all three combined. So here is the supply side snapshot for Greenville, South Carolina, the metro statistical area. There are 644 properties that are conventional apartments in this marketplace, totaling 48,790 units, so a tertiary market. There are currently 4,426 units under construction, and in the last 12 months, only 56 more units rented than went vacant, versus the prior period, 2,372 more units rented than went vacant. So an extreme slowdown in absorption, and this shows in the vacancy rate where it has gone from 6.4% to 8%. We are still seeing a year-over-year increase in rents. We will see what it looks like quarter over quarter. We are not looking at the capital market. We are only looking at the space market. If we come down to the long-term occupancy average, over the last 22 years, you can see that it likes to be at about 92.25%, and it is currently sitting at 92%. So right on that long-term occupancy average. May even argue it is starting to slide a little bit below it, but I think it's safe to say that when we go to plot this at the end of this session today, when I plot it on the market cycle chart, we're probably going to find that it is going to be on the long-term occupancy average in between the oversupply and recession phase. But first, let's go take a look at the data and see if the data confirms it. So here is our rent analytic data for all three asset classes in the Greenville metro statistical area of South Carolina. We do not look at asking rent. We don't care what they are asking for rents. We only care what they are actually collecting. So as you can see, in the first quarter of 2022, they were getting $1,248, went up to $1,306, stabilized through the next quarter to $1,307, and then went down to $1,295, and then there was a very slight uptick in January of 2023 of $1,299. So let's see if the deliveries and absorption confirm what we see in the rents. So there were 100 units delivered in the first quarter and 277 absorbed. So over double, almost triple what was delivered. So that is a good showing in absorption. Another good showing in absorption with 140 delivering and 310 absorbing. So you can see that we went from 93.3 up to 93.7 up to 94.1. But then things started to slow down. 80 units deliver, only 10 absorb, so we ticked down in occupancy to 93.9. Then almost 600 units deliver, and another 385 units go vacant. So big tick down in occupancy at that point. And then 32 units absorb in the month of January with no deliveries, so no change in occupancy at that point. But remember, we had about that $4 or $5 growth in rents in the first quarter, in the first month of January, and we're seeing this a lot around the country right now. And I think the primary reason is there was a lot of news that inflation was easing, that the Fed was going to start easing on interest rates, and so people were feeling a little better, And so the ownership decided, well, maybe we can increase rents and see if we can't get them. And it did absorb a little bit. So even the renters were feeling good at that time. But as we know, interest rates today is March 2nd, 2023. Interest rates today, the 10-year went back above 4%, and residential rates went over 7%. Even Freddie Mac went up another 15 basis points today. They are at 6.65%. So interest rates are on the rise. Inflation is still climbing. So it'll be very interesting to see as the quarter keeps going. Well, let's take a look and see what each asset class is doing individually. And we will start with Class A. So here is the Class A rent analytic data for Greenville, South Carolina metro statistical area. There are 42 properties in the market totaling 10,497 units. Looking at effective rent, they were at $15.49 in the first quarter of 2022. Went up to $16.40, down to $16.17, down to $15.74, and then up to $15.89, much like we saw with the overall. Let's see what deliveries and absorption tell us. So we had nothing deliver in the first 3 quarters. We had some absorption in the first 2 quarters with negative absorption in the third, and then 477 delivered with another 89 going vacant on top of that. So that explains our downturn in rents between the second and third quarter. It acted appropriately, your demand supply principles. Then 56 units did absorb, and for that reason, rents went slightly up. And we did see an increase in occupancy from 87.5 to 88. So that explains that little uptick. That said, the Class A market is responding appropriately to demand supply principles. So the rents are reacting correctly. Let's see what story the Class B rents are telling us. So here is the Class B rent analytic data. There were 199 properties totaling 23,087 units. We started first quarter 2022 at 1,239, went up to 1,297, up to 1,312, down to 1,302, and slightly up to 1,305. One can argue kind of stabilized. All right, so slight roller coaster happening here. Let's see what the deliveries and absorption tell us. So we had 100 units deliver, 231 absorb. So good, strong absorption. 140 units deliver, 160 absorb. Again, good, strong absorption. 80 units deliver and 76 units absorb. Again, good, strong absorption. And that explains why that inflection point did not happen until between the third and fourth quarter, where we did go down in rents. And this would tell you why. We had 112 units deliver and another 243 go vacant. So we went down in rents in the fourth quarter, and then remember we went up a little bit in the first month of 2023 in January, and we had 123 units absorbed with no deliveries. So once again, the Class B story is it is reacting appropriately to demand supply principles. So far, we cannot argue with the data that we have seen for the Greenville, South Carolina metro statistical area, which is a little bit of a change over what we've seen the last couple of days. All right, but this is reacting appropriately based on what we're seeing for deliveries and absorption. So let's see if the Class C market is telling us the same story. Here is our Class C rent analytic data. There are 352 properties totaling 15,116 units. Looking at effective rent, we were at $9.96 in the first quarter of 2022, up to $10.27, down to $10.22, up to $10.34, down to $10.31. We got a little bit of a roller coaster action here. Let's see what absorption tells us, because we shouldn't have any deliveries. Let's see what absorption is telling us. And sure enough, we have down, up, down, down, down. Now, we are seeing a little bit of a different trend than we saw with the A's and B's. The A's and B's reacted appropriately to demand supply. Demand being your absorption. So if people are moving out of the market and not into the market, that is negative demand. So consider absorption our demand. And then the amount of units is supply. Okay, that's our occupancy. So our demand is waning big time, especially going into the month of January, yet we saw an increase in rents in the month of January, and this is telling us we should not have seen that increase. So we saw Class A react appropriately to demand supply. We saw Class B act appropriately to demand supply, and the Class Cs did not. A little bit of a roller coaster effect with an uptick in absorption. Now, keep in mind that we are still pretty low in vacancy. 93.9, you can argue it is 94%. That is still fairly low for the Class C market. So one could argue that you're trying to drive that down a little bit further until you get to about 93%. So it looks like they're almost there. If this trend continues, we'll definitely start to see that downtrend going with the rents for the Class C market. So what does this mean for Greenville, South Carolina? Well, I think it's safe to say that with the long-term occupancy average sitting, that occupancy sitting right on that long-term occupancy average, with absorption slowing and going negative in Class C, and the rent trends following what absorption is doing, so reacting appropriately to demand supply, except in the C-class properties, I think I'm pretty safe on plotting Greenville, South Carolina right here on the long-term occupancy average in between oversupply and recession. I think we'll see it drive into the recession phase. Maybe the next quarter, might take 2 quarters to get there. I think it's heading that direction, but right now we're just kind of hovering right here on the long-term occupancy average. So that does it for the Greenville metro statistical area. Stay tuned tomorrow as we finish this week with Fort Myers, Florida. So I have not peeked. I don't know what it's going to tell us. I'm hoping we see what the data shows for the effects that the hurricane had. Remember, Hurricane Ian hit this market late last summer, and it'll be interesting to see what the demand-supply principles tell us for this market. So I will see you guys tomorrow to finish the week out with Fort Myers, Florida.